Joining us now for his take on trade and the broader markets, Jeremy Siegel, University of Pennsylvania Wharton School finance professor. Jeremy, Professor, very good afternoon to you. Thank you for joining us. I mean, first of all, your thoughts on the fact that the markets have been so positive and resilient, whether it's last week or today, despite some of these negative trade headlines.
Well, I think this was a wonderful labor market report we got Friday, and that was a blockbuster. The best possible outcome, strong job growth, rise in the participation rate, less pressure on unemployment. I think the big rally we had Friday and today is mostly due to that great labor market report that we had. It really means that there's a chance the Fed is not going to raise 4 times this year, and we're not going to squeeze on the labor supply. Again, just a chance because it's only 1 month of data, but I think that's what we're keying off of the last 2 days.
So we get a really good jobs report, and then we talk about the Fed not raising interest rates. I mean, how did the narrative change? It was better economic reports, signs of inflation meant the Fed was going to continue marching along, raising interest rates, and that could stand as a headwind to this market.
Yeah, well, you know, the key, I know on CNBC they all guess what is the jobs increase going to be. Actually, probably a more important number to guess is what is the participation rate going to be? How many people are going to be entering that labor force? Because we know we've been producing a demand for labor of between 200 and 225,000 for the last year, and yet supply from population is only 100,000. We need those people that have not been involved in the labor force to come in and take that pressure off. We can grow quickly then without the Fed raising rates too much. Again, we got 1 month. I remember back in February, we had a 0.3 jump in the participation rate, and over the next 3 months, it all dissipated. So, you know, I don't want my excitement to get too high, but it is certainly a move in the right direction. We got 0.2 of an increase, little less pressure on that labor market front. Let's hope for the best here.
Professor, how are valuations at the moment as we approach earnings season?
Very reasonable. On basis of 2018, operating earnings were about 17.5, and in a low interest rate world, and we're in it, even though the Fed is increasing, that's a very reasonable rate. I don't think we're going to get quite the increase in earnings that some people think 2019, but certainly you can't say that we're anything like wildly overpriced at these levels for today's market.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.